All right, today we're diving into a really interesting one, the quantum computing firm Rigetti. We're looking at its stock, RGTI, because right now it's telling two completely different stories at the exact same time. The data is literally pulling in opposite directions, which suggests it's at a critical tipping point. So the big question is, which way is it going to go? Let's break down the evidence.
Okay, so first things first, let's just get our bearings. This chart shows you what's been going on with Rigetti's price lately, and you can see the story right away. It's one of pressure. See that recent downward trend? That's the backdrop for this whole bull versus bear battle we're about to get into.
And here it is. This is the number at the center of everything. $38.84. That was the last closing price. This single number is our starting point for all the analysis that's about to come.
And that really brings us to the main event, the core question. After this recent drop, is Rigetti down for the count, or is a comeback actually brewing? What makes this so fascinating is that the technical data, the numbers, they seem to be arguing with themselves, telling a totally contradictory story.
Yeah, the technical report we're digging into shows a stock with a split personality. It is a classic Wall Street showdown between the bulls, who are sniffing out some potential here, and the bears, who see a lot of weakness. And it's all playing out right now in these charts. So, before we even think about picking a side in this tug of war, we've got to understand the battlefield. Let's kick things off with a clear snapshot of where the stock stands right at this moment.
Okay, let's crunch the numbers. The price recently dropped almost 2%, and it did so on lighter than average volume. But here's the kicker, the really important detail. Look at its position in the 52-week range. It's just 4.4% off its absolute low for the entire year. That tells you market sentiment has been, well, overwhelmingly negative. And that's the context that makes the other side of this story so interesting. So, with all that negative feeling in the air, let's start with the bearish case. Why do some of these indicators suggest the stock might have even further to fall?
So what exactly are bearish signals? Well, just think of them as warning flags that the data is planting. They're these technical patterns and indicators that, when you put them all together, suggest that the path of least resistance for the stock price is, you guessed it, down.
And for Rigetti, wow, the bears have a really compelling case. The price is stuck below its key short-term moving averages, and they're basically acting like a ceiling it just can't break through. The MACD, which is a big trend-following momentum indicator, is negative. Another tool, the momentum indicator, confirms that short-term slide. It all just paints a pretty clear picture of weakness.
But if the story was that simple, we wouldn't be here, right? The data is hiding a completely different narrative. So now let's flip the coin and take a look at the bullish case. What signs of strength are lurking just beneath the surface?
And bullish signals, as you'd imagine, are the exact opposite. These are the green flags in the data. They're the little clues that suggest a stock's price might be getting ready to climb, and they're what give traders a reason to start getting optimistic. And here is where the plot really thickens. The stock RSI, which is a tool that measures how fast the price is moving, is deep in oversold territory. That's often a sign that a bounce is way overdue. And get this is the key contradiction. While the price is below its short-term averages, it's actually still holding above its long-term ones. That suggests the bigger picture is still positive. Add to that some positive readings from volume indicators, and you start to get the feeling that maybe some smart money is quietly buying up shares. That is a powerful counter-narrative.
Okay, so we have these two totally opposite arguments, and both are backed by actual data. What on earth does it mean when they're both happening at the same time? Let's try to make sense of all these mixed signals. This slide just captures the conflict perfectly. You've got the bears with all the short-term momentum. The price is stuck. But then you have the bulls, and they have the long-term trend on their side, oversold conditions that are just screaming for a bounce, and signs of accumulation. It is a perfect statistical tug-of-war. So what's the final verdict from the technical report? It gets summed up as a weak trend with mixed signals, slight bullish bias. Now that little phrase, slight bullish bias, that's key. It suggests that even though things are really uncertain, those bullish arguments, like the long-term trend and the oversold conditions, they carry just a little more weight than the bearish ones. But the main takeaway is still weak and mixed. There is no clear winner here, not yet.
This kind of uncertainty creates one thing for sure: volatility. The report flags a key volatility metric at over 13.5%. In simple terms, what that means is that this stock has a tendency to make really big daily price swings. When the bulls and bears are this evenly matched, you should probably expect some fireworks.
Okay, this brings us to what I think is the most important part of this whole analysis, the key price levels you need to watch. The report tells us that the next big move for Rigetti, whether it's up or down, is probably going to be triggered by one of two very specific numbers.
I want you to think of these levels as a floor and a ceiling for the stock price. Whichever one breaks first will likely decide where the next major trend is headed. First up, let's talk about the floor. It's at $37.20. This is the key support level. For the bulls to have any chance at all, the price must stay above this line. You can think of it as their last line of defense. And now, looking up, we've got the ceiling at $41.96. This is the key resistance. For the bulls to prove they're actually in control, they need to smash right through this barrier. And ideally, they need to do it on high trading volume. So here's how this whole thing could play out. We've got two very clear paths forward. For the bulls to win this fight, they have to defend that 37.20 floor and then make a run at the 41.96 ceiling. For the bears to win, it's even simpler. They just need to break that floor. A break below 37.20 would confirm all their momentum and could open the door to a much, much larger drop.
So we are left at a truly fascinating crossroads. The evidence is balanced on a knife's edge with really strong arguments for both a rally and a decline. The technicals have told their story, and now the only question left is, which path will the market choose to take? The answer is going to be written in the price.